as possible. Will not go much into the theoretical definition of everything. The objective is it should be understood by everyone, and anyways, definitions you can easily get it online. So here, the primary objective is to understand the concept behind it. Okay, so let's continue with the financial markets. So what are financial markets? Financial markets are the markets where you can trade financial securities. So these securities could be anything. It could be, I believe that most of you have heard about stocks, shares, we commonly call, right? So financial securities, it could be stocks, debt, or say currencies, or commodities. It could be, these are the few asset classes for the financial securities. So on high level, you can see the financial market. These are the few examples of financial markets. One could be capital market, which is mostly for medium to long-term raising of funds. Money market, which is primarily for short-term borrowing and lending. As of now, we just take it on the high level, then we'll see each of the market in detail later on. So money market is just for short-term borrowing and lending. So the duration could be as short as overnight, and it could be max 1 year. It should not exceed 1 year. So the few of the examples could be certificate of deposit and commercial papers. These are the money market instruments. Then forex, foreign exchange market, which is for 24/7 market. Not exactly, but 24/7. But you can see that is the largest market by market turnover. Then commodities market, wheat, all those commodities which are getting traded. So these are part of financial market. Then there is a derivatives market, futures, forwards, option, swap, warrants. So all these are part of derivatives market. We'll take up derivatives separately in another session. Okay, so today our primary focus will be on capital markets. Okay, let's start with the capital markets. So as I mentioned earlier, capital markets are for I would say medium term to long term raising of money. Everybody needs money. Say it could be companies, it could be government. So they need to raise money through securities. Right? So when I say capital market, I'm talking about raising money. Okay, and who could raise it? It could be companies or it could be government. Government needs money for their spending, for their expenditure. Same thing is true for companies, right? So for that, they will ask investors to fund them. Okay, so how they will ask investors? So there could be two types of securities. One, it could be equity. Second one, it could be debt or bonds. So for example, if I am a company, I want to raise $1 million. So what I will tell to investor that, okay, I'm giving you a part of my company. Okay, so I'm selling the ownership of the company in forms of shares and stocks. So that will be part of equity market. So in this case, how am I raising the money? By selling the part or say ownership of my company. So I'm raising it through equity. Another way to raise money through investor is to borrow a money from them. So that will be called as a debt securities. So in debt, as a company or a government, they are borrowing money from the investor and providing them a fixed set of returns over the fixed period of time. So on high level, if anybody says capital market, it consists of equity and debt. Equity, stocks, shares. What are stocks? They represent ownership in the company. So as a stock owner, you are also a part owner of that company. For debt, you are just borrowing money from the investors with a fixed set of interest and a fixed set of duration. For example, I could borrow 100 million with a rate of interest for 6% per annum, and coupon payment, say yearly. Usually that interest part is called as a coupon in bond. So what it means for bonds, say if I'm borrowing 100 million with 6%, and say it is 20 years bond, it means that, and say the coupon payment is annually, it means that at the end of every year, I need to pay my investor 6% of 100 million, which is 6 million, okay, for 20 years. So what kind of cash flows will be there? So at the end of each year, I will be paying my investors 6 million, at the end of second year, 6 million, at the end of third year, 6 million, till 20th of year, 6 million, plus I will give them their 100 million back. So this is same as borrowing, say if you're borrowing between your friends. So you will say that, okay, I'm giving you 100 rupees and 10% is the interest rate on annual basis. So in this case, the 10%, 10 rupees at the end of the year will be called as coupon payment. So you will give your friend 10 rupees at the end of 1 year. And say if you want to close that borrowing, then what you will do? You will give him 10 rupees plus your 100 rupees, right? Which is your principal. So these are the few terms: principal, or the, so in this case, the principal is 100 million. So this is just a high level overview of equity and debt. So I will summarize one more time. Objective for the capital market, like for companies or for government, is to raise long-term fund for their spending and expenditures. Everybody's got their own spending. So it could be done through two ways. Selling a part of the ownership. It means that, okay, now when you own this a part of the company, or doing it through debt. You are just borrowing money from the investors and giving them fixed returns and for the particular duration. So now we'll see, as we are here on the stock and equity and debt, we can see a few of the advantages and I would say the points, important features of this. So for equity, as you are the owner, right? So here there are no fixed returns guarantee. But with bond, returns or your coupons are fixed. Here I am assuming the bond is not a zero coupon bond. And the risk reward ratio, what could be the risk reward ratio for equity and debt? For equity, it will be high risk, high reward. For debt, it will be risk is low risk, comparatively stable, or I would say the low or stable reward. Stocks, usually your equities are highly volatile. These are less volatile. Apart from that, there are several features like, say, in case of bankruptcy or in case of liquidation, debt holders will get priority over the equity holders. And in terms of voting rights, equity holders will have a voting right, but debt holders will not have the voting rights. Okay, so these are the few differences, or you can say the features of equity and debt securities. So the whole objective is you should understand what are equities and debt. Like, why am I doing, like, what are the features for equity? So on high level, you should understand it's mostly deals with the ownership. And this usually deals with the borrowing. Okay, so this is how you can raise money. So when somebody says capital market, it's equity, debt market. Equity is for ownership, debt is for borrowing. Okay. So it is like capital market. Equity, debt, and this market could be primary and secondary. So we have already discussed equity markets, examples, stocks, or what we call as shares. Debt, it could be bonds, it could be treasury bonds. So now we'll see what are the primary market and secondary market. Now see, as I told you that a capital market is for raising fund for long term. So now as a company, if I want to raise $100 million, okay, so how will I do that? So what I will do is I will raise that 100 million to the investor. Like I will issue new securities, say I will issue the new equities, and I will give it to the investors in the primary market. So to summarize, to keep it simple, I would say that when the new securities are freshly issued to the investors, this is done in primary market. It means that, say if I am a new company, ABC organization, and if I want to raise fund through equity, what I will do, I will just say that, okay, for ABC Capital, I have divided my equity shares into 1 million number of shares, and I am willing to give this 1 million shares to investor at 100 rupees. At say 200 rupees, right? So this initial offering to the investors will be done in primary market. So have you heard of the term IPO, initial public offering? So basically, this is what your primary market. So say through the IPO, a new securities will be issued to the investors. So again, there are a lot of processes, like there will be a bank involved which will do the underwriting and they will decide the price band and all. Will not go much into the detail. To keep things simple, you should understand when securities are issued. First, it will be through primary market. Okay. Now we'll see what is secondary market. So now securities are already issued. See, if you got a company ABC organization and you have issued 1 million securities at 200 rupees. Now that is done. Now the role of primary market is over. Now the security is available with multiple investors. Say if one person A got 100 shares of this at 200 rupees, person B, he does not have any shares with him, but he is interested in buying the shares. So where will he go? How can he do that? So for that, he cannot approach primary market again, because now the role of primary market is over. Securities are issued. Now what person B will do? He will say that, okay, I am interested to buy this security. Where should I go? So he will go to the secondary market. So the secondary market will consist of, say for example, he will go to a stock exchange. And will try to buy the security. Okay, so if a person B decides to buy, say, shares of ABC organization, he cannot buy it directly. He has to go to a stock exchange, say either through stock exchange or through OTC market. OTC market will take it up later, but as of now, to keep things simple, he has to go through a stock exchange to buy the security. Even if the person B is willing to buy the security, can he directly go to the stock exchange and say that, okay, I want to buy this ABC shares for 200 rupees? No, he has to go through a broker. Okay, so as a rule, you should only transact through stock exchange or through broker, or if you are a member of the stock exchange. So these are the only two ways. Usually, the main broker is the member of the stock exchange, and then you got several brokers through which you can transact. So the structure will be person B will go through a broker, and then it will go through stock market. So the stock market is a place where the buying and selling of securities, or in particular stocks, will happen. As the name itself says, stock. So when somebody says stock market, it deals with equity, because stocks are equity, right? So stock market is for shares, and where the buying and selling of stocks will happen. And to buy shares, you have to go through a broker, right? Now, what is the role of stockbroker? Stockbroker will only facilitate the buying and selling of securities. For example, if you go to your stockbroker and will say that, okay, I want to buy 100 shares of ABC securities, then a stockbroker will place an order for that 100 shares for that particular security, and if it gets executed, you will get your shares. So broker will only help in facilitating the buying and selling of security. In return for that, you will get its own commissions. So this commissions could be the percentage of the trade, or it could be fixed. So broker is only interested, like his primary concern is to facilitate the trade, and in returns he will get his brokerage. Stock market, they will do the order matching. When I say on high level, I would say that if somebody is willing to sell ABC shares for 200 rupees, and say in this case the person B is willing to buy ABC shares for 200 rupees. In this case, it will just match the order and execute and provide the executed fills to the stockbroker and to the clearing members. So this is just on high level I'm talking about. Let's say the broker, for buying the security, you have to go through broker. Stock market is the market for buying the securities. Hello. Okay, so we have already discussed one example for bond where the principal was 100 million, 6% as the coupon rate, annual is the coupon payment frequency, and 20 years is the duration. So we discussed that, okay, at the end of first year you'll get 6 million, and at the end of second year you'll get 6, at the end of third year, and after 20 years you'll get 6 million plus 100 million. So overall you'll be getting how much? 20 into 6 equal to 120 million plus 100 million equal to 220 million over the period of 20 years. So 220 million is the final cash flow for 20 years. Now we can see what kind of returns you will get for equity. Say if you bought a ABC share at 200 rupees. Does that mean that every year you will get some part of 200? No. As we discussed earlier, for equities, returns are not guaranteed. So as an equity investor, you are looking for price appreciation. It means that, say if you bought it for 200, over the period of time, say after 1 year, the price of this share becomes 250. Okay, so you already got 25% return in 1 year, right? So one of the objectives for investing in equity could be price appreciation. So example is, say if you bought it for 200 rupees, after 1 year, if the price is 250 rupees, so your 1 year returns are 25%. And second one would be dividends. So as an equity investors, you are also interested in dividends. Dividends are basically the profits of the company which they are sharing with all the shareholders. Say for example, if there is a $100 million company, when I say $100 million company, it's I'm talking about the market capitalization, okay? And say if there are 1 million outstanding shares, and if they say that, okay, we got a 100 million profit and we want to give 100 million profit to all of our investors. So what they will give us, 100 million of profit given to 1 million shares. So it means that one share will get 100 rupees. So this is what? So this will be paid in cash, right? So it means that the company who got 100 million in profit is trying to, as every shareholder, I told you that it's an owner. So even they got a right for the profit. So they are distributing the profit in terms of dividend. So each of the investors will approximately get 100 rupees per share. So this is the second income you are looking for, dividend income. So as an equity investor, your returns are not fixed, but on debt side, you got all the cash flows which will be coming to you known in advance. But in equity, things are not certain. See, if this company is giving dividends, then you will get the dividend part of it. Or if the company is doing well and the price is appreciated, you will get price appreciation. But there could be other scenario also. If the company which you have bought for say 200 rupees, it's not doing well, the price may go down to 150 rupees after 1 year. So in that case, you are losing, see, 50% of your investment, right? And they may not give dividend as they are already running into losses, right? So based on that, based on the risk profile or based on the company's future projection, how is it doing, they will invest in equity or in debt. Yeah, and just to add on dividends, many times a company will say that they will not give dividends, they may reinvest in the existing capital. So in this case, they will just reinvest the profit. So the impact will be seen in the price. So it's not necessary that all the profit, all the companies which are giving good profits, they will issue dividend. They may decide to reinvest the dividend. That will just on high level as of now. As of now, just concentrate on the two part: equity, price appreciation, and dividend. These are the two forms you are looking for. So for this session, we'll just summarize whatever we have discussed. So we have discussed on capital market. So we said that the capital market consists of equity and debt. So capital market, it's the way to raise long-term funding. It could be done through equity and debt. And there are two phases of it: primary market and secondary market. Primary market is the market where the securities are issued to the investors. New securities are issued to the investors. For example, IPO, initial public offering, is an example of a primary market. Once the securities are available with the investors, they can trade it only in the secondary market. And secondary market involves stock market